So the S&P 500 is entering a bear market all because of Trump's reciprocal tariffs that he didn't get right. He announced more tariffs on China than any other country, which is coming hard on the Chinese market. We just saw Hong Kong go down 10%. This is the most since 1997, which is insane. Guys, you have to prepare yourself. You have to know what to do. So we're going to talk about what to do in this video because there's a lot happening. We have to find the grounds to invest in fundamentally sound companies because we have to have that vision knowing that in the next 5 to 10 years, these companies will remain strong and they have tight moats. They're not going to get disrupted by Trump's tariffs because they have their own strong business. So let's get into what I've been doing in the market. So when Trump announced the reciprocal tariffs, it crashed the market and a lot of people are coming out. A lot of famous investors like Bill Ackman, like Daniel and Dan Ives, they're all coming out and saying these tariffs are causing a lot of panic in the market. People in the tech industry don't know what to do. Should we get our investments back into USA? Like they don't know how to plan out the future. So it's not going to cause industries or CEOs to like invest right away. They're reacting hectically like everyone else and they don't know what to do because nothing is strict and in place because Trump is all over the place with his policies. 1 minute he's tariffing a country, 1 minute he goes back on the tariffs. We just don't know what's going to happen in the economy. So what do you think CEOs are going to do? They're not going to react with hardcore investments until everything is stable. There's no uncertainty in the market. And that's pretty much what Bill Ackman is saying and a lot of investors are saying. So what he's doing is causing a lot of disruption in the market. And Hong Kong is kind of fighting back. They announced their 34% tariffs back on the USA. Even Europe is considering tariffs on the US as well. So this turmoil is causing a lot of strife in the market. So as investors, we still got to go back to the fundamental principles of investing. And Peter Lynch always talks about these corrections happening. What Peter Lynch is saying is that you do not want to get scared out of these positions because if you get scared of these positions when they're still fundamentally sound companies, you're doing the wrong thing at the wrong time. You want to be buying companies if you think they're undervalued, but you just want to inch in. But you don't want to bet the farm right away. You just want to put kind of lots in, like one here, one there. So that's what I'm doing with Baba. Baba just announced they're buying back more shares. Guys, they're trading at a forward PE of around 11. And remember, they're getting heavy into AI. We have OpenAI having a $30 billion valuation. We know that Alibaba's cloud division in their AI is actually competing directly with OpenAI. So if they have a $30 billion valuation for OpenAI, we have Alibaba as a whole company selling less than 30 billion right now because the stock is crashing. Alibaba's international revenue with USA is like 2 to 3%. Whatever Trump says or whatever Trump does is not going to affect Alibaba. It's majority domestic. The AI, the cloud, the commerce, it's all domestic and international. Turkey with Southeast Asia. So why are you worrying about Baba's price crashing? You should be buying more. And then this goes on to my next topic of JD.com. JD.com still has a $5 billion buyback. So that's already 8% of the company. Their free cash flow yield, it's already around like 11 to 12%. Plus they're growing 5-7% top line. Their net income is actually growing faster. Their free cash flow is growing faster. So you can kind of see a 20% return. They upped their dividend by 30%. So we're also getting a dividend on top of the buybacks, the dividend, the growth, the already high free cash flow starting point. So why are you scared? Domestically, 100% of JD.com's revenue is in China. China is doing massive stimulus right now. So this is all going to boost the economy. It's all going to make people spend more in the domestic economy. So right now, there's so much capitulation in US and China is doing the opposite. They're stimulating the economy. US is not stimulating the economy. They're holding back. So why wouldn't you go where the tide is going? China is stimulating the economy. They're putting more money to get people to spend more money, and kind of USA is kind of faltering back or just not doing as much. We have the perfect tidal wave of where China is going to be going in the next 4 to 5 years with all this stimulus. USA is, we don't know because remember, back-to-back years, 20% S&P returns, that's insane. That just doesn't happen very often. We knew there was going to be a market sell-off, but not like this. That was really unexpected, but man, we take advantage of these situations. So we have two companies that domestically all their revenue is in China. We have them stimulating the economy. You should be happy at these prices going down if you're a true investor. Unless you're afraid of USA going to war with China just because of these tariffs, I highly doubt that. So guys, I'm a really heavy buyer right now. I think these are amazing prices, especially when JD is selling below a 10 PE, buying back 8% of the shares. Like, It's a steal right now. Guys, tell me what you're doing in the market, especially if you're an Asian buyer. Guys, like and subscribe to this channel. Peace.